Good morning, investment webinar attendees. We have a number of you on the phone so far, and we're going to give it another 1 or 2 minutes to see if the rest of the people join, and then we'll get started. Welcome to the webinar. Good afternoon. I'm Joe Baker, Chief Financial Officer at Fairfield County's Community Foundation, and I would like to welcome you to our investment webinar update for our charitable fund. Our mission is to create a vital and inclusive Fairfield County where everyone has the opportunity to thrive. We accomplish this goal by supporting programs such as the Center for Nonprofit Excellence, expanding economic opportunities for women and young adults, and supporting nonprofits through grant making and our FCCF Giving Day, which just raised $1.4 million for Fairfield County nonprofit organizations. We also advise fund holders and make grants and scholarship awards that totaled $17.2 million last year. As a fund holder, professional advisory committee member, or other constituent of the foundation, you have an interest in the investment and performance of our charitable funds. This webinar session will provide you with an update on our investment process and strategy. Much of the information we will share with you today is on our website on the About Financial Information page. We are also recording this webinar and we'll be posting it to the website so that you can view it later if you wish. A couple of housekeeping items. On the right side of your screen, you should find a task pane. This is where you can type in questions and submit them. If you don't see the task pane, look for and click on the orange box with the arrow in the upper right-hand corner of your screen. That should open the pane for you. The pane may close after several minutes of inactivity, so just click on the arrow again to reopen it. You may submit questions at any time. We have a moderator who will be gathering questions throughout the webinar, and we will answer questions at the end of our presentation. You can also let us know about any immediate technical issues you're having through the question function, and we will reply to you directly. To get started, I would like to introduce our two presenters to you. John Bailey is the chairman of the Foundation's Investment Committee and a member of our board of directors. John has served in that capacity since June 2014 and helped identify and hire our independent investment consultant, recruit new members to the investment committee, and recommend high-performing investments for the portfolio. John is the founder and managing partner of Spruce Private Investors, which serves as a chief investment office and asset manager for family offices and charitable institutions, managing over $1.5 billion in assets. Also presenting today is our independent investment consultant, Kathy Kanicki. Kathy is a partner with NEPC and the team leader for NEPC's Endowment and Foundation Consulting Group, which manages over $62 billion in assets. NEPC is a national investment consulting firm serving clients with assets of over $1 trillion. She is a member of NEPC's Alternative Assets Committee and Global Asset Allocation Advisory Group, and she is a chartered financial analyst and a chartered alternative investment analyst. Kathy has worked at NEPC since 1991. Thanks to John and Kathy for joining us today. First on the agenda, John will share information about the Foundation's investment program, spending policy, asset allocation, and performance. Then, Kathy will describe NEPC's market outlook, current opportunities, and the Foundation's strategy going forward. Finally, we will respond to written questions submitted in the GoToWebinar questions pane. Now, let's get started. John?
Hi, good afternoon. Thank you, Joe. I appreciate that. Good afternoon, everybody. This is John Bailey, Chair of the Investment Committee, and I'm pleased to speak with you about the Foundation's investment program. The Investment Committee has worked very hard over the past several years to build an investment program and a portfolio that can perform well in a variety of market environments. Responsible stewardship of the Foundation's charitable assets is one of our most important functions, and a responsibility that I and my fellow members on the Investment Committee take very seriously. The Foundation manages $231 million in assets in nearly 600 charitable funds. The Foundation offers 4 investment options. The first is a long-term investment portfolio with 88% of our assets. Second, a Vanguard index portfolio with about 3.5% of assets. Third, a money market portfolio also with 3.5% of assets. And the remaining balance is an investment advisor portfolio. This presentation will focus on the Foundation's long-term investment portfolio. The investments for the Foundation are overseen by the Board of Directors, which approves the Foundation's long-term asset allocation, annual spending policy, investment consultants, and investment committee membership. The investment committee is made of practicing institutional quality investors who each bring specific areas of expertise to the committee. Now, we're going to talk about spending policy as the first area to drill into. And we would say for 70% of the assets in the Foundation that are endowed, the Foundation employs a spending policy to maintain their purchasing power over time. The Foundation spending policy is calculated as the difference between our long-term portfolio expected return and our outlook for inflation to determine the spending policy amount. Each year, the Investment Committee considers a number of factors to arrive at the annual spending policy recommendation to the Board of Directors. The current spending policy is 4.5% for grants and administrative spending. Spending is calculated each year on a 12-quarter trailing average of a fund's balance. For example, a designated fund would spend 3.5% of the trailing 12-quarter fund balance for grant making, and perhaps 1% of fund administration fees. The spending rate is the mainstream of foundations and endowments nationally and reflects the muted return expectations going forward. The Foundation spending policy is an important consideration of determining the Foundation's asset allocation. And in terms of asset allocation, the Investment Committee works on a regular basis with our investment consultant, NEPC, to review the investments program's target asset allocation. When thinking about the appropriate asset allocation, our goal is to maximize the potential for long-term growth, while also targeting a mix of assets that will help the Foundation to meet its 4.5% spending rate after inflation. The investment program is well diversified and global in nature and reflects our long-term market outlook. The current target allocation is 53% in equities, 15% in fixed income, and 32% in alternative investments. While there is no explicit target for opportunistic investments, the investment policy does provide flexibility to invest up to 10% in opportunities that might be shorter term in nature, provide a unique return opportunity, or do not fit easily into another category. The equity portfolio provides balanced exposure to U.S. and non-U.S. markets with dedicated exposures to U.S., international developed markets, and emerging markets. The Foundation also has a target to broader global equities, where we believe active managers should benefit from a broader opportunity set and flexibility to move between markets. The fixed income portfolio is highly liquid and is balanced between safe haven treasury and inflation protected or TIPS exposures, and global multi-sector strategies, which are actively managed and are flexible in their investments across credit, rates, and currency markets. While treasury and TIPS provide safety, the global multi-sector managers should provide higher yield and return potential, and currently without significant exposure to rising interest rates. Within alternatives, the foundation has a 10% target to private equity and to private real assets, respectively. We expect these programs to be strong drivers of return for the foundation going forward. Examples of these high-value investments include private equity secondary investments, distressed investments, private real estate, and energy. Our private equity program is off to a strong start with a 12% net internal rate of return since inception. The private real asset and real estate program has an 11.3% net internal rate of return. Our private asset program is overseen by a private equity professional on the committee who is a top quartile performer and who has invested billions of dollars in private investments. These programs must be built over a number of years, however, in order to achieve proper diversification, which explains the current underweight relative to our targets. The target to hedge funds is another 12% in addition to the private equity and private real assets. The role of the hedge fund exposure is to provide diversification and diversified returns that are less correlated to traditional stock and bond markets, and to hopefully provide some protection in down markets. Moving on to performance, the foundation has experienced strong returns in the current fiscal year. Fiscal year to date through January, the foundation returned 13.9% and has outperformed its benchmark return of 11.5%. The fund's overweight to equities, combined with strong outperformance by equity and hedge fund managers, has helped performance during this fiscal year. The one-year return of 21.3% is also strong on both an absolute and relative basis. Over the 3, 5, and 10-year periods, the foundation has had success in beating its benchmark. As of December 31st, the foundation ranked in the 3rd percentile of the endowment and foundation peer universe, outperforming 97% of its peers for the fiscal year-to-date period. And that reflects the strong results experienced since mid-year 2017. The rank for the full calendar year is also top decile, as the foundation ranked in the 8th percentile of its peer universe. Over the 3, 5, 7, and 10-year trailing periods ending December 31st, the foundation continues to outperform its policy index and is consistently ranked in the top half of its peer universe. And now I will turn it over to Kathy, our independent investment consultant, who will speak to you about our market outlook and our strategy going forward.
Thanks, John. Good afternoon. This is Kathy Kinnicky. NEPC has partnered with Fairfield County's Community Foundation and the Investment Committee since 2015. We provide investment consulting advice to the Investment Committee to help meet the goals and objectives of the long-term investment pool. I will discuss our market outlook for 2018, our current opportunities, and how the long-term investment pool is taking advantage of these opportunities. We have a dedicated asset allocation team who annually develops a market outlook, which is the building block for our clients' asset allocation and potential investment opportunities. We have 5 key themes for our 2018 market outlook. Many of our themes are similar to what you may have heard from us last year. The first theme focuses on our belief that we can continue to have an extended U.S. economic cycle. Although this has been a long economic cycle, growth has also been slow and steady. The health of the U.S. consumer can continue to drive economic growth. We don't see any significant signs of a potential recession unless inflation accelerates, leading to a tightening of financial conditions. There is the potential for continued return in the domestic equity markets. However, valuations have gotten stretched, and we want to be mindful of our allocations to domestic equity. Our second theme is synchronized economic resurgence, and this is new this year. Global economic conditions are improving in a synchronized fashion. Positive growth rates harmonized across the globe are relatively rare. We haven't seen this since before the market crash in 2008. And persistence of this theme over several years could provide a substantial benefit to equity markets globally, especially in Europe and Japan. Economic resurgence, however, is delicate and can be disrupted by lingering global risk factors. U.S. dollar strength, dislocation in China's credit expansion, and restrictive U.S. trade policy pose the greatest threats. Our third theme is Federal Reserve gradualism. The Fed is willing to let the economy grow and have some inflation. A relatively accommodated Fed is likely to continue unless there is a dramatic acceleration in inflation. However, the impact of the Fed unwinding its balance sheet is unknown and untested as to the impact on markets. Monetary policies in Europe and Japan continue to be accommodated, which can also drive equity prices upward outside of the U.S. Our next theme is China and their transition from a manufacturing economy to a service economy, while also seeking to slowly let their currency float. China still has the fastest growing economy, and any stumble along the way through these transitions can have repercussions on the global markets. Finally, weak economic growth and uneven wage gains over the last decade have fueled political discontent in the West and the move to populism. Populist movements such as Brexit or the US election have destabilized the established political order, but are not inevitably bearish for equity markets. Both the UK and US stock markets have significantly increased subsequent to their populist events. While shifts in US trade policy did not materialize in 2017, a more aggressive protectionist policy would represent a material risk to global markets and the world economy. We'll have to see how the steel and aluminum tariffs that were imposed in 2018 will impact the economy and the markets going forward. Here are some of our current investment opportunities based on our market outlook. As I walk through these points, I will also address how the long-term investment pool has adopted these opportunities. First, we recommend trimming U.S. equities back to a target weight due to higher equity valuations. The long-term pool is overweight to domestic equities. However, this is due only to the significant underweight to private markets, which may take up to 5 years to build. The holding place for private equity investments is global equity and cash. Our next recommendation is to overweight non-US developed markets due to opportunities in Europe and Japan, although as we know, these markets still carry risks. These markets tend to lag the US markets. The long-term investment pool has a healthy allocation to non-US developed equities at a target of 17%, a little bit higher exposure there. Plus, you get developed international equity exposure from the global equity managers. The investment program is overweight versus the target allocation. We also like emerging markets due to their potential for higher economic growth, and these markets are more undervalued than the rest of the equity markets. The long-term investment pool has good exposure to the emerging markets through their dedicated managers. The global equity and developed international equity managers also provide some additional exposure to emerging markets. Our next opportunity is to allocate to Treasury inflation protected securities, known as TIPS, from core bonds to provide a hedge against realized inflation and to also improve the risk balance across economic environments. The long-term pool has an allocation to TIPS. Finally, global macro strategies are positioned to perform well in times of uncertainty or elevated volatility, such as we have seen so far into 2018. Global macro strategies have the ability to have long and short positions across currencies, commodities, bond and stock indices. They can help mitigate what we call the left tail of a portfolio return distribution, i.e. negative returns. The investment pool has an allocation to 3 very complementary global macro managers. In summary, the long-term investment portfolio is monitored versus goals and objectives on a monthly basis, and to ensure that the long-term investment pool has the appropriate asset allocation and investment managers. So the strategy going forward, we are forecasting subdued market returns over the next 5 to 7 years, which will make it more challenging to meet the foundation's and the long-term investment pool's return goals. The foundation is focusing on strategies and asset classes that may be less liquid, but offer the potential for higher returns than the equity and bond markets to help meet return expectations. The private markets programs, which represent a combined 20% of the target allocation, are expected to be a key driver for performance going forward. These investments will include private equity and private debt, such as buyout funds, growth equity, or distressed investments, and private real estate and energy. It will take 4 to 5 years to carefully build these allocations up to the 20% target. A strategic pacing plan is developed to determine the dollar amount to commit to private markets each year. Identifying and evaluating investments in these areas is a key focus of the investment committee. As these programs are being built out, the foundation will be overweight other parts of the portfolio, and liquid placeholders have been identified, such as equities and cash for private equity. The hedge fund allocation has been reduced over the last few years and restructured with new managers who provide significant diversification characteristics, such as the global macro managers we have previously mentioned, to the rest of the portfolio. Additionally, the investment policy allows for up to a 10% allocation to opportunistic investments when unique opportunities are brought about by dislocated or unusual market conditions. These opportunities usually present strong risk-adjusted possibilities. As these opportunities arise, they will be evaluated for suitability within the foundation's portfolio. This year, the portfolio recently made their first opportunistic investment. So how do NEPC and the investment committee work together? We seek to add value to the foundation's long-term investment pool by leveraging our research capabilities for both the strategic asset allocation and manager selection across traditional, alternative, and opportunistic investments. We work with the investment committee to develop and stress test an asset allocation target that is forecasted to achieve the target return based on the fund's liquidity needs and risk sensitivities of the long-term pool. The asset allocation target is reviewed on an annual basis. We monitor the underlying investment managers to ensure that we have the best-in-class managers across all asset classes. Passive management is used for more efficient asset classes. Our extensive research team works with the investment committee to review and discuss potential investment managers for the private equity and private real estate real assets programs. Finally, we will look for opportunistic ideas to tilt away from the strategic allocations and take advantage of shorter-term dislocations in the market. Then lastly, just about NEPC, we have been helping our clients meet their investment goals and objectives for over 30 years. I have been with NEPC for 26 years and a little bit more than that. We are a very stable organization. We are owned by our 38 active partners, and our only focus is investment consulting. Our size allows us to have a 47-person research staff and extensive consulting resources. However, our dedicated endowment and foundation practice team allows us to focus on your needs and help the foundation in the long-term investment pool meet your investment goals and objectives.
Thank you, Kathy and John. Now we're going to take some questions. I'm going to begin with some questions that have already been submitted. And please feel free to continue submitting questions through the question function in the task pane. Remember, if your task pane has been minimized, you can open it back up by clicking on the small orange box in the upper right-hand corner of your screen. The first question is for Kathy. Can you give us an example of an opportunistic investment?
Yes. So the beginning of 2018, the investment committee approved an investment in what we call government-sponsored enterprises like Fannie Mae and Freddie Mac non-performing loans program. This is a $53 billion market where these government entities have to start to eliminate these non-performing loans from their balance sheets. And so the investment committee approved a manager that is going to be investing in these loans, which we think is kind of an opportunistic opportunity right now. The added advantage to this organization that the investment committee approved is that they're a minority and women business-owned entity. And the government-sponsored entities have a separate program for selling loans at auctions to only minority women business enterprises, and there are very few competitors in the market. So this organization, this fund has a lot of expertise in dealing with non-performing loans, but they also have the added advantage of competing in a loan pool that there will be very few competitors. They'll be able to get better prices on these loans. So this is kind of a fixed income strategy that doesn't fit into the long-term private equity, private debt lockups, or into your traditional fixed income. So it was put into the opportunistic bucket because it's unusual, and it also is an opportunity that you won't see the next 3, 4, 5 years out.
Thank you, Kathy. The next question I have is for John. What is the private equity placeholder that we saw in the asset allocation?
Hi, this is John. So the private equity placeholder is really a temporary holding place for assets or capital that will be in the future committed to private equity, real estate, and oil and gas. But of course, those private investments, they're of for the advisors that are on the line, they'll know this quite well. But private equity and real estate and things of that nature take a while to build out the investment program. Prudence would really require us to take a measured pace of investment, whereby, let's say, we make 2 investments per year in private equity and 2 investments per year in private real assets, and we just keep doing that year after year. To eventually, we build up our full commitment and allocation. But even once we commit the capital, which is really going to be done over a 5-year time frame, even as we commit the capital, the managers we're committing to still require a pace to invest their capital. And on average, they take a 3-year time frame to invest their capital. So as we commit the capital and then the capital slowly gets invested over a 3-year period for each manager, that means that there's a fair amount of that capital that has not yet been put to work. And so we need to do something with it. And what we do is we put it in a placeholder vehicle, which is liquid in nature, and it reflects both global stocks. Our 2 global managers, we've given them some additional capital to manage for approximately half of the allocation. And then the other half of the allocation is going to reflect a more liquid real asset exposure. And that's something that we're in the process of finalizing with State Street Global. So between State Street and between our 2 global managers, we'll have liquid investments that will be invested in a fairly similar manner to what the private equity plan calls for. But as our private equity managers make capital calls to us, we're able to fund those capital calls and pull them out of the liquid placeholders. And hopefully the placeholders in the meantime will be generating, certainly a better return than cash. If we just had the capital sitting in cash for up to 5 years, that return would just be way too low and would actually bring down the entire category of our private equity investments.
Thank you for that explanation, John. We've got a few more questions, and I encourage attendees to submit more. This question is for Kathy, and it is, what is NEPC doing to help the foundation pick high-performing private assets in a crowded market?
That is a question that we get quite frequently from our clients, given the amount of money that has gone into private equity. We take a top-down look at the markets, first of all, to see what markets we think are the subsectors within private equity that will do well going forward. And then we try to find the best-in-class managers within those allocations. But one of our biggest focus when we're looking at what private market managers to recommend and approve for our clients, we want to find managers that really pay a lot of attention to the price that they're going to pay for their investments. That they're going to be patient and not just go buy investments at higher prices than they've historically done because they have capital to deploy and want to get more capital to be invested. So it's really important to spend a lot of time researching and understanding these managers to ensure that they're going to adhere to the same investment process that they have used in their prior funds, and to buy companies at lower valuations. And many times these are going to be kind of managers that are going to be buying special situation type investments where they can go and actively help to improve the companies. But these aren't not always just distressed companies, but they're really focused on valuation. So that's where we think that we're trying to find the value add for our clients with regard to finding the best private equity managers in a more crowded space.
And if I may, Joe, this is John. The investment committee also, we work very closely with NEPC, of course, and the relationship has been very good. But we also have some leading, institutional quality volunteers on our investment committee that come out of the private equity world. And so, we feel it's part of our responsibility to also be looking for opportunities and to work with NEPC and proposing attractive managers and funds that we come across. I mean, we've added somebody to the committee over the last several years that, consistently has been a top quartile performer in the private investment space. And so not only is he doing deals himself directly, but he knows who the competitors are, and he knows what the pricing cycle is, and what the terms are, and so he gets great deal flow and competitive information flow, if you will, and that helps us enormously in unearthing opportunities and working with NEPC to analyze the opportunities. We have somebody else that has done probably over 100 transactions. On a frontline basis for a company that he was CEO of, and he's got decades of experience in working with private equity firms and who the principals are, and when firms, teams are spinning off and creating other entities, he knew who they came from and which firm that they came from and who they worked with, and he's also been invaluable in getting very attractive kind of frontline information. And then finally, we've got, we're in the middle of recruiting other folks. In particular, I'm thinking of another gentleman who actually works for one of the world's leading research firms focused on private equity and private real assets. So in addition to NEPC, the investment committee, I think, has really, done a very good job of bringing on board top-tier kind of frontline quality to help us source opportunities and evaluate them with NEPC.
Thank you, Kathy and John. It's a good example of how we try to build a strong three-legged stool at the foundation with respect to investments, with strong internal management, deep consulting expertise, and attentive committee members. I'm down to my last question, so if any of the participants would like to submit a question that they haven't yet, now's a good time. This is a question, we'll start with John to answer it. How will the portfolio perform in an environment of increased volatility?
Yeah, I mean, that's one of the big questions to ask. You know, we've been taking steps to try to diversify out the portfolio. You know, we just rebalanced the portfolio. You know, we saw some fantastic gains from 2017, and we went through the committee and with NEPC, and we went and rebalanced the portfolio to kind of cut back on some of the big winning areas. Really, that was mostly on the equity side. And I think if we go area by area within equities, you know, we've been trying to, you know, move into some lower price markets, for example, overseas, and cutting back on the huge, almost decade-long rally we've had in the U.S. and a tremendous period of outperformance, of relative outperformance versus non-U.S. Stocks. But we think that'll actually help with volatility as we move, you know, and diversify the portfolio internationally more. Adding some of the global macro type managers that are non-correlated that actually tend to do pretty well during periods of dislocation. If you look back in 2008, global macro as a strategy was actually positive in that period. And then, you know, there were a good number of managers that actually put up some pretty nice performance. And then I think our expansion into the private areas, while we are fully aware of the fact and respect the fact that these investments carry an inherent level of volatility, they're not as affected by the daily mark-to-market volatility necessarily that the public markets would be. But I think with all of this, you know, the concern that we have that's just really a broad-based market observation is, you know, we should all be prepared for a period of higher volatility. And, you know, we do expect our managers to manage with that volatility, or to you know, proactively manage the exposures of their individual parts of the portfolio. But it is likely that, you know, we're going to be in a period of higher volatility on an ongoing basis, number one. And number two, I think in terms of return, we should also not quite expect the returns that we've gotten last year on a go-forward basis. So, you know, we have relatively modest expectations for returns in the short run. You know, but with that said, I think the portfolio has performed pretty nicely given the recent bout of volatility we have, and, you know, we still feel comfortable that it'll perform pretty well given all of the changes that we've made over the last, really, you know, 2 years. We think they'll do pretty well in that period of volatility.
Thank you, John. Kathy, would you like to add some comments about how NEPC is helping clients design portfolios to address the volatility we're beginning to see?
Sure. And I think, you know, John has addressed a lot of the comments, especially too as it relates to the foundation's long-term investment portfolio. But I think that diversification is a key component in making sure that you've got asset classes that will work differently in different types of market environments. I think what also can help with increased volatility is having managers who have flexible mandates, which you have a number of those in your portfolio, who can, you know, with this volatility, they can go and find the opportunities in the market. For example, within fixed income, you have kind of what we call kind of global multi-sector fixed income managers. So they can look to find the best opportunities, you know, whether or not there's increased volatility or not, but they can decide, do they want to be in the US? Do they want to be outside of the US? Do they want to be in credit or sovereign issues? And also, do they want to change duration? So if they see the interest rates are going to be increasing, there's that potential for them to shorten the duration of their portfolio to minimize potential losses from the increased volatility of having rising interest rates in the portfolio. You also have that with global equity managers. So they could canvas the whole globe for stocks to find the best opportunities. And if they see volatility is higher in one area, then maybe that's the area they want to stay out of. The other point I want to make, though, is that, volatility can also be good. I mean, for active management. Active managers, which you have, a mix of both passive and active management in the portfolio. But active management has had, since, the last 8 years with the strong, just upward momentum of the stock markets, it's been very difficult for managers who actively manage their stock portfolio to add value. When you get into periods of increased volatility, those managers should have a higher probability of being able to outperform the passive benchmark because they can take advantage of some of this volatility.
Thank you very much, Kathy and John, for responding to the questions and for presenting the Foundation's investment program for the Foundation. For participants, I welcome any questions or comments that people have, and I thank you very much for the respective roles you have with the Foundation as fund holders, professional advisors, friends, and other kinds of supporters. We appreciate that very much, and we look forward to serving you further. If you'd like to learn more about our investment program, you can see that in the About Financial Information page on the website, and we look forward to talking with each of you in the future. Have a good day.
Thank you, everybody.